We tend to imagine that the global financial system was built openly, through official treaties, public debates, and transparent policies. But much of the system that shapes the modern economy didn't emerge in the spotlight. It was shaped quietly, through private meetings, backroom negotiations, and secret agreements between powerful bankers, governments, and industrialists. These deals didn't just influence markets for a few years. They shaped the foundations of global finance for generations. And once you start looking at history through that lens, you realize something unsettling. Some of the most important financial decisions affecting billions of people were made by a very small number of individuals, often behind closed doors. To understand how secret deals shaped the financial world, we can begin in the early 20th century, during a period when the United States was struggling with repeated banking crises. At that time, America didn't yet have a central bank. Financial panics were common, and when they hit, the entire economy could freeze almost overnight. The Panic of 1907 was especially severe. Banks collapsed, stock prices plunged, and the financial system came dangerously close to total breakdown. In response, a small group of powerful financiers decided that the system needed a fundamental redesign. In 1910, several of the most influential figures in American finance secretly gathered at a private resort on Jekyll Island, off the coast of Georgia. The group included top bankers and government officials who believed that the country needed a centralized institution to stabilize the banking system. To avoid public suspicion, the meeting was conducted in extreme secrecy. Participants traveled under false names, and even many insiders within the financial industry didn't know what was being discussed. Out of that meeting came the blueprint for what would later become the Federal Reserve System. Officially established in 1913, the Federal Reserve would fundamentally change how money and credit flowed through the American economy. Supporters argued it would prevent financial panics and provide stability. Critics worried it concentrated enormous power in the hands of central bankers. But regardless of where you stand on that debate, one fact remains: one of the most influential financial institutions in the world was born from a secret meeting among a handful of elites. The pattern of quiet agreements shaping global finance didn't stop there. A few decades later, another meeting would define the international monetary system for nearly half a century. In 1944, as World War II was still raging, representatives from 44 nations gathered in a small town in New Hampshire. Their goal was to design the post-war financial order. This conference, known as the Bretton Woods Meeting, produced a set of agreements that would dominate global finance for decades. The US dollar was positioned at the center of the system, backed by gold at a fixed rate. Other currencies would be tied to the dollar, creating a global network of exchange rates anchored by American financial power. Two major institutions also emerged from this arrangement, one designed to support reconstruction and development, and another to stabilize international currencies. On the surface, these decisions were the result of international cooperation. But behind the scenes, negotiations were heavily influenced by the economic dominance of the United States at the end of the war. America held most of the world's gold reserves and had the strongest industrial base. That leverage allowed it to shape the rules of the system in ways that favored its financial position. For several decades, the Bretton Woods system provided stability. Exchange rates remained predictable, global trade expanded rapidly, and economies rebuilt after the devastation of war. But the arrangement also depended on a delicate balance, the promise that dollars could always be converted into gold. By the late 1960s, that promise was becoming harder to maintain. The United States had expanded spending dramatically, funding both the Vietnam War and large domestic programs. Dollars were circulating around the world in quantities far greater than the gold reserves backing them. Foreign governments began to worry that the system might not hold. Then, in 1971, a decision was made that would permanently change the nature of global finance. In a televised announcement, the U.S. government suspended the convertibility of dollars into gold. This effectively ended the Bretton Woods system and moved the world toward the modern era of floating currencies. While the announcement appeared sudden to the public, the negotiations and planning behind it had been developing quietly among policymakers and financial leaders. By breaking the link between money and gold, governments gained far greater flexibility to manage their economies, but they also created a system where the value of currencies would depend largely on trust and policy decisions rather than tangible backing. That shift opened the door to the financial environment we know today, one where central banks play a massive role in shaping markets, interest rates, and liquidity. It also set the stage for the explosive growth of global finance in the decades that followed. Another example of quiet influence can be seen in the rise of international banking networks in the late 20th century. As globalization accelerated, major banks expanded across borders, creating interconnected financial systems that could move capital around the world at unprecedented speed. While this increased efficiency and investment opportunities, it also meant that financial crises could spread much faster. When the global financial crisis struck in 2008, the interconnected nature of the system became painfully clear. Banks had built enormous exposure to complex financial instruments tied to housing markets. When those markets began to collapse, the shockwaves traveled through institutions across continents. Behind the scenes, governments and central banks held urgent meetings to prevent a complete financial meltdown. Emergency liquidity programs were launched, massive rescue packages were negotiated, and central banks coordinated policies to stabilize the system. Many of these decisions were made within days, sometimes hours, and often involved intense private discussions among policymakers and financial executives. The public eventually saw the results: trillions of dollars in support for financial institutions and unprecedented interventions by central banks. But the process itself highlighted a recurring theme in financial history. When the stability of the system is at risk, the most critical decisions are frequently made by a small circle of officials and financial leaders working behind closed doors. This doesn't necessarily mean that these actions are always malicious or conspiratorial. In many cases, secrecy is used because financial systems are fragile. Public panic can accelerate a crisis, and policymakers often believe that quiet coordination is necessary to maintain stability. But it also raises an important question: who truly shapes the rules of global finance? The reality is that financial systems evolve through a mix of public policy, economic necessity, and private influence. Governments set laws and regulations, but banks, corporations, and investors play powerful roles in shaping how those rules are implemented. When crises emerge, those relationships become even more visible. History repeatedly shows that the architecture of finance is rarely built in a single moment. Instead, it emerges through a series of decisions, some public, some hidden, that gradually reshape the system. A meeting here, a policy shift there, a quiet negotiation between governments or financial institutions. Over time, these moments accumulate and redefine how money flows around the world. For the average person, these events can feel distant and abstract. Yet their consequences reach into everyday life. Interest rates influence mortgages and business loans. Currency values affect the price of goods and international trade. Banking regulations determine how stable or unstable the financial system becomes. Understanding the hidden side of financial history isn't about assuming secret conspiracies behind every policy decision. It's about recognizing that power and influence tend to concentrate where money and institutions intersect. The individuals making key financial decisions are often not the ones appearing in headlines, but the policymakers, bankers, and advisors operating within the system itself. A larger lesson appears here. When major financial systems can be influenced by a handful of private decisions, the strength of the entire structure depends on the motives and judgment of those making them. At times, their choices support long periods of economic stability. At other times, they quietly create weaknesses that only surface years later. History shows that monetary systems are never permanent. From gold standards to modern floating currencies, each shift has begun with decisions made by a small circle of policymakers, bankers, and political leaders. So the next time you hear about interest rate decisions, financial regulations, or currency policies, it's worth remembering that these policies don't emerge in a vacuum. They are the product of negotiations, incentives, and sometimes quiet agreements that rarely make headlines. Global finance may appear to be an enormous machine operating automatically, but in reality, it is built and maintained by people who meet, debate, and occasionally strike deals that shape the economic future of entire nations. The story of those deals is often hidden in the background of history, but their impact is anything but small. They determine how money moves, how crises unfold, and how wealth is created or destroyed across the world. Understanding that reality doesn't mean rejecting the financial system. It simply means recognizing how it evolves and who influences its direction. Because once you see how global finance has been shaped in the past, you begin to understand that the system we live in today is not fixed. It is the result of decisions, and future decisions will shape what comes next. If this gave you a new perspective on how the financial world really works, make sure to subscribe. History often hides the most important lessons in places most people never think to look, and the more you understand those lessons, the better prepared you'll be for whatever comes next.